The following presentation is brought to you as a courtesy from Forex Academy. This is part of our service, Become a Pro course. If you find it interesting and wish to be updated on new releases, please subscribe to our YouTube channel or join our community at forex.academy and receive all our services for free. Your like is also highly appreciated. Enjoy.
Hello, good day, and welcome to today's Become a Pro bonus webinar lesson. James here at Forex.Academy, and you're very welcome to enjoy this bonus lesson. We'll be discussing quantitative robustness evaluation of a trading system. Very interesting topic indeed. Before we consult and go through today's bonus webinar, please do reference the following disclaimer. There is risk involved trading the financial markets. Of course, we do like to go through a few pieces of housekeeping before we begin each live interactive webinar. Feel free to ask questions throughout, guys. So you have a chat box there located on the right-hand side of the screen. If you have any questions throughout, I can correspond with you and obviously be able to see some of your comments and questions on screen, go back through some of the charts that we'll look at and actually express in more detail some of the topics of today's conversation. This live webinar is being recorded and will be placed into your members area once we have concluded again. So for revision purposes, if you could just give us a 1 hour grace period there, we'll have that uploaded to your members area. And we will, of course, be hosting an extended Q&A session at the end of this live webinar. So we have 2 bonus webinars to look forward to today, addressing the first bonus webinar 1, again, quantitative robustness, evaluation of a trading system. It's going to focus around your ability to evaluate your own trading performance, develop that into a system, whether you'd like to develop a rules-based approach and follow a consistent method in terms of entering and exiting these markets over the long term. That will deliver an overall element to your success. Bonus webinar 2, again, we'll be conducting. It will review some popular methods of trading in financial markets. So we'll discuss scalping, swing trading, technical day trading strategies, amongst others. Let's look at today's particular webinar outline. We'll be discussing in detail the Van K Thorpe approach, mathematical expectations of a system and its importance, the mean and standard deviation of a distribution. So if you're looking to trade with technical indicators using perhaps statistical inference, you're going to need to know that there is an average or mean level of trading activity within each financial asset you'd like to trade. And deviations from that mean can be quite significant in terms of applying technical analysis or trading strategy. We'll look at mathematical forecast of performance, a method of system evaluation. Again, we have some primary methods of evaluation, whether you'd like to journal your trading and develop that into a system, whether perhaps you'd like to journal over a long period of time your trading strategy as opposed to your risk-reward approach. Some traders like to develop, of course, for the Forex markets, a negative risk-reward approach over a distribution of 100 trades. And if they are profitable with that trading strategy, although negative in risk-reward ratio, they will apply that strategy over the long term as it delivers profits. The only way you can define this is, of course, by looking to develop that, journal that, and obviously turn it into a system of evaluation. We'll look at objectives in terms of position sizing. And again, I cannot reiterate enough that financial trading is so much about risk than allowing yourself to avail of opportunity. Profitability rules, again, we're looking to objectify calibration of those risks. So again, guys, your method to actually apply yourself is going to relate to as a function to your success, okay? Now that is not only in terms of the amount of money that you make in a very short or medium term, it's your approach. You're trying to develop and foster an approach to successful trading, whether it be a rules-based approach or not, or perhaps a statistical means that you'd like to develop a more, I suppose, structured objective trading strategy, that you have a stop loss in place, you don't change the strategy, and it's almost mechanical in nature. Let's move forward then, and we're going to discuss a very famous American psychologist and author here, Van K Thorpe, his approach and writings towards the industry of trading, financial trading, risk control, and position sizing. Okay. His approach focuses on trading where a trader will never again let luck, superstition, or gut feeling get in the way when trading the markets. Okay. Now, this approach is to be said for professional trading as an industry, I suppose, where you cannot be an emotional trader all the time. Now, we are, of course, human in nature, and we do have emotions, greed and fear being but a few of those natural emotions. However, as a job, just like a professional lawyer or doctor cannot, over the long run, let emotions factor into his overall performance as a medical or legal professional. It's the same for trading. So Van Thorpe teaches how to model effectively by pointing out what highly accomplished traders all have in common. Again, if we look to profit in the markets, why don't we look to see those most profitable traders and model their approach? Once a trader masters the common tasks and behaviors of accomplished traders, as well as the beliefs, mental states, and also the mental strategies, the chances of success improve. Again, that's all what we're trying to do again with our education. Look to not only educate ourselves on a practical level, but mentally and almost spiritually, in terms of how we approach the markets with our focused appreciation on the greed and the fear factors that we see in the markets. Each trader ought to have a method or a system for his or her trading without an approach to spot and execute trades. You may never be a consistent performer if that's the case. So we look to really develop that systemic objective that we have in terms of developing an approach to execute trades. Simply put, even though you may be quite a skillful scalper, perhaps you might place 30, 40 trades in a day, it is much more difficult to actually remain consistent like that unless you're very skilled for a long sustained period of time. Why is that? Because each individual trade is down to your own emotion and your own stop loss as you enter the trade. Whereas if you have something a little more technical in nature, you're going to objectively take away some of that emotion in your strategy. Your system could be a roadmap that guides your trading and keeps you from creating decisions when you are least able to do so. Again, if it's a more objective trading system, perhaps, as I said previously, mechanical in nature, you may look to trade technically so that you actually don't trade in front of your trading screens. You place pending orders. Your stop losses will be executed once your order is entered. And of course, it's almost computer or mechanical in nature that derives and takes away that emotional aspect to your trading. And of course, if you're able to do so consistently, then, well, you can go about your daily day job, of course, whether you have a 9 to 5 in another industry, and effectively trade the markets with a statistical approach. And that is going to lead to an overall approach of a consistent performance. Trading can be stressful, and what you do not would like, trading can be stressful, and what you do not want is to be canned like a system in a box, a one size fits all, because it simply does not work. And we know that with regards to financial trading, you don't want to box yourself into a one size fits all model, because if you're trading different asset classes, of course, they move in totally different nature to any one particular asset. I'll give you an example. If you use the same strategy for your cryptocurrencies than you may use for your Forex markets, and again, using the same strategy for equity markets, well, some markets will be trending, some will see more volatility, and of course, the price action is going to be completely different for one another. So one size does not fit all over financial markets. One of the biggest secrets of successful trading is finding a trading system that matches you personally. And we often say that is the case, guys. Why is that the case? Well, if we want to focus on one aspect, let's say risk or an appetite for risk, we know that some people are much more risk averse. Some people like to take on a little more risk because they are in search of a little more profit. And again, you could argue, for those to take on too much risk, there's an element of greed there. But again, if you're taking on too much risk when the time is right, well, then you're just trading what you're seeing and you're reacting to the market. So it does have to match you personally, your own trading strategy in terms of how you implement it and how it suits. For those traders who really like to take a decent amount of risk in the market and are successful at doing so, if they were to revert back to a really risk-averse trading strategy, that would not work for them. Okay, they don't see the profit available in that strategy, even though it may be consistent at a lower rate. It doesn't suit their makeup, and that is the same for those who are more risk-averse. They don't want to turn a new leaf and start to trade with much higher risk. So it does have to find that balance between your character, your personal character traits, and your trading strategy. Developing your own system allows compatibility with your own beliefs, objectives, personality, and edges. Okay, and that's what you want to do. You want to make a trading system or strategy that is compatible with your personality, your trading edges, your objectives. Okay, so that needs to be in line with expectation. Let's say you're a trader and you want to approach the markets and say, well, I'm going to invest £500 or €500 in the trading account. By the end of the month, I want to have €1,200 or pounds. Well, that is quite a return on your investment over a short period of time. Is it compatible with your own beliefs? Is it compatible with your personality and your edges? Perhaps it's compatible with your personality, but with your trading edge, if you're relatively new to the market, of course, you're more likely to be gambling with that sort of risk-reward ratio than to trading the markets. And again, is it compatible with your objective? Is your objective to get in with one trade and make a lot of money? That may be the case. If your objective is to invest €500 to learn how to trade so that you want to become a consistent, profitable trader over the long run, yet you have a short-term objective of making €700 profit from a €500 account in 1 month, you can see what I'm getting at here, guys. That does not stack up. If you are serious about becoming a trader, then you need to approach trading with the same level of commitment that you would approach any high-level endeavor. And of course, if you're going to invest money as well as it's a financial pursuit. People invest money in terms of their education for university, perhaps, thousands and thousands of pounds over 2 or 3, 4 years of study, so that they want to develop skills to go to the workplace, perhaps to apply for careers later on, whether they want to become doctors, lawyers, teachers, whatever it may be, or work in the financial sector. Of course, that's a high level endeavor, so there's a level of commitment there. So trading should be the same. Again, if you're a part-time trader, you can focus on the fact that you are part-time, and observe the level of risk towards your personality and your objective to your level of commitment. If you want to really, super succeed and excel in these markets, there's going to be a higher level of commitment that you're going to need to focus on your trading. The market does not owe you or anyone else nice riches, but it can lure you with that promise solely to take your cash and leave you with nothing. And that is a true facet, unfortunately, with financial trading. The markets are irrational, guys. I have to be honest. The markets are often very, very irrational. They do not owe you anything. If you have traded the markets, even with good technical analysis and good technical trading ability, and you're perhaps taking seven or 8 losers in a row, the next time you're saying, well, the market owes me some money, the next trade has to be a winner. That is not the case. The market does not owe you anything. It doesn't even know you're there trading the market. So just take that into account. It can lure you with the promise, because it can be quite a lucrative environment in terms of the profits made. Okay, trading is a very, very profitable environment once you can apply the skills, and that lure, do not let, I suppose, pull the wool over your eyes in terms of the amount of time and effort that you're going to need to develop in skill and discipline to get to that level. So let's look at this mathematical expectation of a system and its importance. Okay, now we'll go through risk-reward ratio, pip exposure and pip values, operating within a statistical framework, i.e. 2 times the spread is one example here, expected realistic profit, okay, as well, and accurate trade size calculations and notional trade size. Well, why is it so important? Well, what we want to focus on with our trading, even though sometimes you'll make a trade and it'll be completely wrong, the market will turn around, move against you straight off the first pip, and just go straight down to your stop loss and you'll take a €50 loser. That happens. But what you want to focus on in the long run is accuracy, control over your capital, objectivity and control of decision making, and realistic expectations. Now you can make this mathematical in terms of expectation on your system, your trading system, okay? So what does that mean? Mathematical, well, you want to be rigorously precise in all walks of trading life here. You want to be completely precise. Accuracy is not just about entering the market at a specific time. Accuracy is about the level of risk you take, for example. So let's say you have a €1,000 account and you want to deliver 1% risk maximum on that one particular trade. You'll need to know the pip value to the pip exposure to the risk reward ratio, so that effectively your maximum, let's say if you think it's going to be a 50 pip loser, well, that you don't want to take, of course, but that is your risk management, that 50 pips minus has to equate, €10 or 1% of your capital account. So be rigorously precise in your capital flow into these trading accounts and into these financial markets. Okay, expectation. What does that mean in terms of mathematical expectation? Well, guys, I give you one example of a trader there where, starting a trading account with €500 and trying to not only double that, but make €700 in month one is effectively quite a profitable expectation. It's really, you're going to be taking huge risks to get to that level in a short space of time. So with expectation here, and what we've highlighted here is what you really want is a strong belief that something will happen. So to use the same example, on day one of the month, I fund my account with €500 and tell myself I'm going to make €700 profit. Do I really believe? What is my level of belief that I can do that? I know that I could maybe, hit one or two good trades and get up to €200-300 profit, perhaps, if I'm lucky, perhaps, if I hit two really good trades. But if I'm taking those level of risks, there's a loser around the corner that will perhaps be €200-400 more likely. So do I have a strong belief that I can really bring my account to plus €700 in 1 month from a small trading account? If I am able to do that as well, what I would like to point out is month two. Okay, the start of month two, what sort of approach am I going to take? Am I just going to, after making €700, am I just going to sit back and say, well, I've made €700 this month, what I'd like to make is €100 next month? That is more likely not going to be the case, guys, which is unfortunate, because that's more focused on consistency and risk-taking responsibly. So even though you may be able to outperform 1 month as such, again, in terms of your own strategy, that will be more conducive to taking large bets, i.e. gambling across trading markets. You won't have a strong belief or expectation that will be successful for you, really. So you want to start on the front footing and having those expectations to say, well, look, I have €1,000 in my trading account at the start of the month. I know I'm going to take losers. I know I'm going to take winners. I think I can get to €1,150 at the end of the month. And then next month, we'll see where we go from there. So if you're able to do that 1, 2, 3, 4 months in a row, what sort of expectation are you going to have as a successful trader in the future? You're going to develop more of a strong belief that something will happen, and you'll have belief in your trading system, your confidence, your ability to pick trades, your ability or skill to take losers, and your ability to outperform the markets. But again, people always focus on the riches available and start to overcompensate for risk, and their trading system does not quantify their expectation. Which brings us on to discussing the trading system then. Specific parameters that combine to create buy and sell signals for a given market. Okay, so do you have a trading system, first of all? What is your entry? Is it, if you're really looking to outperform, are you simply saying, well, this is sold off so much, it will come back 100 or 200 pips, and that's all I want, so I'm just going to take a big trade on this? That is not a trading system. There's no real specific parameter. You've just made an attempt to hope that one of these markets comes back and take a trade. That's just one example. What we want to develop a trading system is a distribution of perhaps 100 trades over the course of the month. That over the course of those 100 trades, perhaps each trade runs a 1-to-1 risk reward ratio. Okay, so a €50 winner, €50 loser. but perhaps your hit ratio is something like 60% or 62%. That way, you're actually, taking 62% winners, 38% losers over the course of those 100 trades, and you're going to develop a level of profit there, i.e., let me see, let's do the math there. 62, you're going to plus 12 at 50-50. It's going to be something like €600 profit. Okay, and that's at a 50-50 sort of one-to-one risk reward for €50 in one direction to a €50 loser. Now again, you would have a larger account for that, but it's more focused on a trading system because it's developed over a distribution of 100 trades over a set period of time that runs on a risk reward ratio that perhaps uses the same technical analysis system or setup and looks to create buying signals for a given market. That brings us on then to mean and standard deviation of a distribution. Okay, what does this mean for us as traders? Why is it so important? Well, it's like any financial trading is like any other, I suppose, pursuit where we know we have a huge amount of participation, in task at hand. All these traders have a task to make money. So they're developing themselves not just to move an asset's price, but to look to profit. And they're all in there at the same time. So we have an average accumulation, what we would call the average accumulation, or a viewpoint on where prices are. That can actually be expressed, guys, by simply inserting a moving average trend line. And again, if you want to follow the trend more closely, cut your moving average down in terms of the periods that you're looking to incorporate, perhaps to shorter moving averages. Simple moving averages, again, you can choose for a smoother trend line, or an exponential moving average you can choose for actually looking to take those samples more relative to closer dates to show you quicker changes in price movement relative to the moving average or change in mean. Okay, and this is what we see here. In front, we have effectively the technical indicator called Bollinger Bands. Now, what they do is describe the mean and describe standard deviation from that mean. And we can understand this in terms of statistical inference and as quantitative elements of practical momentum within the market, okay? The standard deviation here is a quantity expressing by how much the members of a group differ from the mean or the average value of a group. So we take this group of all market traders, buyers and sellers, okay? We have a mean or an average pricing nature with the line, the medium term line going through the middle of our Bollinger Bands, okay? Then we set the Bollinger Bands to reflect a standard deviation from that mean. So if you right click in a Bollinger Band, for example, you can choose 1, 2, 3, 4 standard deviations from the mean. And that's effectively what we see with an upper and lower band. How many times does it deviate above, below the mean? Okay, and this is effectively what you see when you see the markets trade up really strongly towards the mean and then reject such levels. Well, there can be sharp movements in price, and that's how we use this one technical indicator, not simply to analyze the price action, but to understand the thoughts and hearts and minds of all these traders involved in the overall trend of the market. Now, you can look at this in terms of trading schools indicators section, because there are many different technical indicators you can look to describe momentum, of course, and a relation to the mean over long-term or short-term trends. But I just want to focus it in on terms of trading strategy, that your trading strategies should be areas where there are profit opportunities that see a change in the mean or a change in perception of mean prices moving or average values of markets moving. Okay.